JAAA's 25% return absolutely crushed. IUSB's 0.68%. That's a massive gap most bond investors completely miss when choosing funds. JAAA delivered 25% over 5 years, while IUSB barely moved at 0.7%. That's a massive performance gap in bonds. But here's where it gets interesting. JAAA's 23% 3-year return shows it's not a one-time winner. It's consistently delivering strong performance across different time periods. Let's zoom in on this. IUSB's 3-year return of 14% shows improvement, but it's still lagging behind where you'd want it to be. In plain English, think of JAAA as the marathon runner who maintains steady pace at every mile marker, while IUSB stumbled early on. In bond investing, consistency beats flashy starts every time. Here's where the story takes a turn. IUSB's 8% return over the year puts it ahead. Short-term momentum's finally working in its favor now. Let's break this down further. JAAA posted a solid 5% 1-year return, though IUSB managed to pull ahead with slightly stronger recent performance overall. Here's the thing, though. One strong year at 8% can't make up for 5 years of nearly flat performance at just 0.68%. In plain English, IUSB might have won the last lap, but that doesn't make it the champion. Just like in race cars, it's the full race that counts, not just your finishing speed. Let's dig into the details. JAAA's Sharpe ratio of 0.5 means you're getting decent returns for the risk you're taking. Solid risk-adjusted performance here. Here's where things get revealing. IUSB's negative 0.6 Sharpe ratio tells you everything. Investors took on risk and actually lost money for their trouble. Now let's put this in perspective. The Sharpe gap here's massive. JAAA rewarded you for taking risk at 0.5, while IUSB actually punished you at negative 0.6. In plain English, risk-adjusted returns are your investment report card. JAAA passed with solid grades for the risk it took, while IUSB didn't make the cut. Same exam, completely different outcomes for these two. Here's the thing, though. A 2.4 Sharpe ratio means JAAA's delivering exceptional returns while keeping risk surprisingly low. That's exactly what investors want to see. Let's take a closer look. IUSB's 3-year Sharpe of just 0.2 means you're barely getting rewarded for the risk you're taking here. Now here's where it gets tricky. JAAA's Sortino, matching its Sharpe at 0.5 means upside and downside volatility are nearly identical. It's really protecting you when markets fall. But that's not the whole picture. IUSB's negative 0.9 Sortino ratio confirms the downside volatility hurt investors more than standard risk measures would have suggested. In plain English, here's the downside protection story. When storm brewing hit the markets, JAAA's umbrella kept you dry while IUSB let you get soaked. Same weather, totally different outcomes. Here's what really matters. A negative 2.6% drawdown over 5 years, that's incredibly stable for bonds. Most funds see way worse swings than that. Now let's connect the dots. An 18% drawdown in bonds? That's the kind of loss you'd expect from stocks, not a supposedly safe fixed income allocation. But hold on a second. JAAA's worst drop was just 2.6%, while IUSB crashed 18%. That's a massive 15-point cushion when markets tank. All right, pause time. Who's your pick? Drop JAAA or IUSB in the comments below. In plain English, maximum drawdown measures your worst-case scenario. Think of it like a balloon deflating. JAAA lost just a bit of air, while IUSB nearly popped. For bond investors seeking stability, that's a huge difference. Now, let's flip the script. JAAA bounced back fast. Just 146 days to recover from a 5-year drawdown. That's impressive resilience for a bond fund. But there's a catch. 3 years of waiting just to break even. That's over 1,000 days watching your money sit underwater. Let's get into the weeds here. JAAA bounced back in just 146 days, while IUSB took 3 full years. That's 7 times longer to recover your money. In plain English, recovery speed matters just as much as the fall itself. Think of it like buildings crumbling. JAAA rebuilt quickly, while IUSB spent years in reconstruction. Both fell, but repair times were vastly different. But here's where it gets interesting. JAAA's worst 3-year loss? Just 1.5%. That's the kind of stability that helps you sleep at night. Let's zoom in on this. IUSB's 3-year maximum drawdown improved to -7%, better than its 5-year period, but still a painful hit. JAAA bounced back in just 19 days. That's capital preservation working overtime to protect your downside when markets stumble. Here's where the story takes a turn. IUSB bounced back in 55 days from its drawdown, faster than before, but still sluggish compared to what you'd want. Like a seesaw, JAAA maintained gentle, balanced movements with quick recoveries, while IUSB created wild, jarring swings that left investors stuck at painful lows for extended periods. But wait, there's more to this story. JAAA is offering a solid 5% dividend yield. That's meaningful income when you're hunting for cash flow in today's low-rate world. Now for the real question. JAAA dominates across the board. 25% returns, minimal drawdowns, faster recovery, and 5% dividend yield. That's comprehensive outperformance. Let's dig into the details. IUSB's 4.2% yield is solid income, but it's trailing JAAA by nearly a full percentage point. That gap matters for income investors. In plain English, think of income like couch change. JAAA's digging deeper between the cushions every month, finding more coins than its competitor. Both funds pay dividends, but one's clearly better at scrounging up cash. Now let's put this in perspective. JAAA's dividend jumped 54% over 3 years. That's rare income growth you just don't see in most bond funds. But wait, there's more to this story. JAAA crushed IUSB with a 25% 5-year return versus less than 1%. Even better, JAAA recovered from drops in under 5 months, while IUSB took 3 painful years after an 18% drawdown. IUSB's 27% dividend growth is solid, but JAAA doubled that pace, something income investors should definitely notice. Let's take a closer look. JAAAs delivered double the dividend growth at 54% versus IUSB's 27%. That's real income expansion versus stagnant payouts. In plain English, JAAA's dividend sprouted faster than IUSB's, like one income tree growing fresh branches every season, while the other adds them more slowly. Both grow, just at different speeds. But that's not the whole picture. JAAA delivers what retirees need most: solid 5% income today, plus 54% growth potential to keep pace with tomorrow's expenses. Let's see how this plays out. JAAA's 5-year volatility sits at just 1.7%. That's remarkably stable, with minimal price swings for nervous investors. Here's what really matters. IUSB's 6% volatility is triple JAAA's fluctuation level, a much bumpier ride for what's supposed to be stable bonds. In plain English, here's volatility explained through roller coasters. JAAA's the smooth kiddie ride, while IUSB gives you bigger thrills with steeper drops and climbs. Same amusement park, just different intensity levels for your portfolio. But hold on a second. JAAA's 1.7% volatility versus IUSB's 6% means you'll sleep better, less drama, fewer wild swings in your portfolio balance. Let's unpack this a bit. JAAA's rock-solid 1.7% volatility is why its Sharpe and Sortino ratios shine. You need stability to win on risk-adjusted returns. In plain English, here's the tightrope walking analogy. JAAA crossed on a thick, stable rope, while IUSB balanced on fishing line. Both made it across, but one journey was way more nerve-wracking than the other. Now, let's flip the script. At just 0.06% annually, IUSB's expense ratio is among the cheapest in the bond fund space. You're keeping more of your returns. But there's a catch. JAAA's 0.2% fee is 0.14 points pricier than IUSB. Not a deal breaker, but those extra costs add up over time. Let's get into the weeds here. Sure, that 0.14% difference sounds small, but on $100,000, you're paying an extra $140 yearly for JAAA. In plain English, IUSB charges less in fees, but JAAA's higher yield more than makes up for it, like paying slightly more tax, but bringing home a much bigger paycheck overall. But here's where it gets interesting. JAAA's 25% return over 5 years absolutely crushes IUSB's tiny 0.68%, making that slightly higher fee completely worthwhile. Let's zoom in on this. IUSB's low fee saved pennies but cost you 24% over 5 years, losing dollars to chase savings. In plain English, here's the thing about fees. They're like mechanical leverage. IUSB's lower costs couldn't save weak returns, while JAAA's fee disappeared against massive gains. Performance trumps pennies every time. Here's where the story takes a turn. JAAA's 0.5 turnover means they're holding positions roughly 2 years on average. That's patience paying off with lower trading costs. Let's break this down further. A turnover rate of 1.1 means IUSB's churning through its entire portfolio annually. That's a lot of buying and selling happening. Let's get into the weeds here. JAAA's turnover is half of IUSB's. That means fewer trades, lower costs, and you're keeping more money from Uncle Sam's reach. In plain English, portfolio turnovers like choosing dance partners, JAAA sticks with the same partner longer, building stability, while IUSB switches more often, staying flexible. Different strategies, same goal. Keep the portfolio moving. Let's dig into the details. JAAA's patience strategy really paid off here. Low turnover at 0.5 combined with 25% returns proves trading less can actually deliver more. Here's where things get revealing. JAAA crushes it across the board, better returns, lower risk, steadier income, while IUSB only wins on costs and recent performance. In plain English, JAAA dominated nearly every round, landing consistent wins while IUSB barely showed up with just 2 punches. This wasn't even close. It's a decisive victory by knockout, folks. But wait, there's more to this story. IUSB saved you 0.14% in fees, but you lost 24% in returns. Cheap doesn't mean smart investing. Here's the thing, though. JAAA checks every box investors care about: strong returns, minimal pain, quick recovery, while IUSB's just offering low fees. Let's take a closer look. JAAA's for short-term safety seekers, while IUSB's built for long-haul investors who'll trade returns for the lowest fees possible. In plain English, here's who these funds are really for. Think pizza slices. JAAA gives retirees the bigger slice with more toppings, while IUSB offers young savers a thin slice that costs less. Same meal, different portions. But that's not the whole picture. Standard legal disclaimer: do your homework and consult professionals before investing your money. Let's see how this plays out. That's a wrap on this battle royale. Hit subscribe if you want more head-to-head breakdowns that reveal the real winners.